Video classes for Level 1 CFA. We'll talk about equity valuation and look at some of the tools we use to value equities, both on an absolute basis and on a relative basis. So when we talk about security valuation, we want to estimate the value and compare it to the market price. See if we can identify an undervalued security or an overvalued security. Hopefully, to earn positive risk-adjusted returns based on our better analysis or better information. So for security valuation to be profitable, we've got to find a security that's misvalued now, but it's got to move toward what we determine is its intrinsic value in the future. And market price is more likely to be correct when a security is followed by many analysts compared to a security that's followed only by a small number. So now let's look at our types of equity valuation models. First one is our discounted cash flow model, and that's really our workhorse model of financial asset valuation. We just estimate the future cash flows that will be distributed to shareholders. I mean, in the case of bonds, we do it the same way, right? Take the present value of the expected future cash flows. So now we can take the expected future cash flows on equity securities, come up with the proper discount rate, take the present value of those, and that's our valuation model. Sometimes we can do this based on dividends, call it a dividend discount model, but if we've got a firm that doesn't pay dividends, we can also look at free cash flow to equity. Free cash flow to equity is thought of as the cash that could be distributed to equity holders. Now, multiplier models, probably the one you're most familiar with, would be a PE model. Come up with the idea and say, well, this firm should have a PE of about 15, and its current earnings are $2 a year per share, so it should be worth 15 times 2. That's a multiplier model. So our price multipliers, we can use stock price to earnings ratio, but we can also use price to sales, price to book value per share, or price to cash flow per share. And sometimes we don't use a per share value, but look at the whole enterprise value. We call this an enterprise value or EV multiplier, and it's typically the ratio of the enterprise value to sales or to EBITDA, earnings before interest, taxes, depreciation, and amortization. Our third type of equity valuation model is asset-based, where we look at the equity value as the total value of the assets minus the liabilities and the preferred stock claims against the company. So now let's look at some of the mathematics of taking these present values. For an N-year holding period, well, we've got a simple model here. And we're going to say, here's the price we expect to get at the end of N years, and in the meantime, we're going to get all these dividends. So if we took all the present values of all these cash flows and added them up, that would be our value of the common stock. Now, you look at this model and you say, well, sure, if I could predict the price 5 years out, I guess I'd be pretty good. And I wouldn't have to worry so much about this valuation. Well, that may be the case, but we're introducing this as a theoretical model just to say the security is worth the present value of its expected future cash flows. So we'll come up with a way of estimating this future value also based on expected future cash flows. But let's take a look at how we would do this calculation. Stock paid a $1.50 dividend last year that will grow at 8% every year. You require a 12% return and expect the stock price to be $51 at the end of year 3. Now, one thing to notice here, this is last year's dividend, so we're looking at future cash flows on this. So our next dividend, we need to grow that $1.50 at 8%, and then grow it at 8% again, and then 8% again for our third dividend, and then the assumption is that we get this $51 sale proceeds at the end of the third year. So these two are just moments apart. The third dividend is paid, and then the value of the stock is $51 after that dividend has been paid. Well, here's D1. Here's D2, our second year dividend. D3, this is also a time 3 value, let's call it P3. So we discount these two values for 3 periods, this dividend that comes at the end of the second year for 2 periods, and the dividend that comes at the end of the first year for 1 period, and come up with a present value of these cash flows of $40.50. So the general form of the dividend discount model just says, take the present value of every expected dividend from now till forever and add them all up. So our assumptions here are that the firm has an indefinite life, and the investor must receive future cash dividends to be willing to invest today. That's what gives stock value in this model here. Now the free cash flow to equity, you'll see it's the same model, but rather than dividends, we've put free cash flow to equity as our cash flows. So we can define this as the cash available after a firm meets its debt obligations and necessary capital expenditures. And if there's preferred stock, well, it would be after those preferred stock dividends are paid as well. Now there's many different ways that analysts measure free cash flow to equity. But one here is we take the CFO, the operating cash flow, subtract off our net investment in fixed capital, in machinery, and then add the net borrowing. That is, if the firm borrowed more principal during the period, we'd add that to free cash flow to equity, because that monies could really be distributed to equity holders. But net borrowing could be negative as well if debt were paid off during the period. So the rationale for using these is that this free cash flow to equity really is indicative of the firm's capacity to pay dividends. They could have paid that out. And it's useful for firms that currently don't pay a dividend when we don't feel comfortable using a dividend discount model and projecting dividends and dividend growth into the future. So under this, the analyst doesn't have to project the amounts in the futures and the timing of these future dividends. It just projects the cash flow. Now, preferred stock valuation, preferred stock dividends don't grow, so it's very much like a perpetuity. These dividends, we expect them to pay them forever since there's no maturity date. And so our present value is just the present value of a perpetuity. We take that dividend payment over the required rate of return on preferred stock, and that'll give us our valuation. And again, this is really just the present value of this infinite stream of constant dividends. Now, with common stock, we expect dividends to grow over time, or at least ideally they will. The Gordon growth model, or constant growth model, is based on an assumption that dividends grow at a constant rate forever. In order to apply this model, this dividend growth rate must be less than the required rate of return. Our expected dividend next period is what we put in the numerator here, D1, and then we divide it by K minus G, the required rate of return on the common equity minus the growth rate. What this does, this formula takes care of the fact that we have an infinite number of dividends. Just like with the preferred stock model or the perpetuity valuation, we had an infinite stream of dividends that didn't grow. Well, notice this about the constant growth model. If growth is 0, then it's the same model as we had for preferred stocks or for a perpetuity. And the higher the growth, the lower the denominator, and the higher the value of the shares. Well, that makes intuitive sense as well. $1 worth of dividends that are growing faster is worth more than $1 worth of dividends that grow more slowly over time. So let's do a quick calculation here. Stock paid a dividend last year. That is D0. And what we need, remember, for our model is D1. The dividend's expected to grow at 8% forever. If an investor requires a 12% return, then we just take D1 here, we've grown D0 at 8%, and then divide it by our required rate of return minus our assumed constant growth rate, and come up with a valuation of $40.50. So please understand, we haven't done anything fancy here. We're really taking the present value of all these dividends and growing them at 8%, discounting them back at 12%. Well, for an infinite series like that, the value actually converges. That's all. So it converges to $40.50. So now we have to estimate the value of G, we have to estimate the value of K, and we have to estimate dividends. Well, let's turn our attention right now to estimating that growth rate. And this is an equation I hope you've seen before, that it is the retention rate, which is 1 minus the dividend payout rate, times the return on equity. Simply put, if our return on equity is 10% and we pay out 60% of that as dividends, then 1 minus 0.6, 40% of that we keep. Well, if rate of return on equity stays constant and we keep 40% of that 10%, then equity grows by 4%. And dividends would grow by 4%. And that's what really underlies this constant growth model. Let's take a look where we use this. The ROE is 18%. Earnings per share last year were $2, and the dividend paid was $1.20. So we've got a payout rate there of 60%. If the ROE and payout ratio remain the same, and the required rate of return is 13%, what's our valuation? Well, we're just going to calculate G here and then plug it into our model. We'll come up with 2218. This is our 60% payout, so 1 minus that is our retention rate, times the return on equity gives us a growth rate of 7.2%. Then we grow that D0, last year's dividend, at 7.2% to get D1 in here. We're given K, the required rate of return on equity in the problem, minus our constant growth rate, and we get a value of 2218. Now, that's for constant growth, and often will be the case that we find a firm that's undergoing rapid growth now, but we don't expect that to go on forever. At some point, the firm growth will slow down to the growth rate of the overall economy or even go into decline. But we're going to assume that there's a fast growth period and that after that, dividends grow at some constant rate for the foreseeable future. So how do we solve this now? Well, remember, we've got that constant growth tool, but we can't apply that until we find a dividend that will grow at a constant rate forever. So we're going to estimate all the dividends, and it doesn't matter if they're smoothly growing or all over the place. Whatever the dividends you have during this early period, you take the present value of each of those, and then you add that to the present value of all those constantly growing dividends that happen after the fast growth period. So we're going to use the Gordon growth model to find that terminal value, that estimated price at year end. Let's take a look at how we would do that. So we've got a stock. Last year's dividend is $1. We've got D0 equals $1. We say the dividend will grow at 15% for 2 years and 5% after that. Our required return is 11%. So 2 years of 15% growth and then 5% growth after that. Well, we have to identify the first dividend that will grow at a constant growth rate. Now, you'll see in many finance textbooks that in order to solve this problem, they'd take it out to D3 and use that in the constant growth model. But that's really an extra step that you don't need to do on the exam. What you need to identify is the first dividend that will grow at a constant rate. So even though D2 is the result of a second year of 15% growth, that dividend of $1.32 looking forward will grow at a constant rate of 5% after that. So here's how we can solve this. We'll use the constant growth model to find the value of the stock one period before, right? Our formula for this infinite stream of dividends was P0 equals D1 over K minus G. So when we plug in the dividend at time 1, we're getting a value one period before that. Just as if we were solving for the present value of a regular annuity where the payments all come one period at the end of each period. So we can calculate using D2, right? That was our $1.32 dividend that will grow at a constant rate of 5% forever. Here's our required rate of return, so we've got our K minus G in the denominator. We put D2 in the numerator, get a value of 22, and that is a time period 1. So it's as if we held this stock and we collected the dividend at time 1, and then we looked forward from that and said, well, we expect a dividend next period of $1.32 that will grow at 5% forever. So we can take the value of all those future dividends using the Gordon growth model and get a time 1 value at the end of the first period right after the first dividend has been paid of $22. Well, once we do that, we just need to take D1. Remember, we started at $1 and had a 15% growth rate initially. So we'll take the present value of that dividend that comes at time 1, D1, and then immediately after that, assume we can sell these shares for their constant growth value based on D2. That was our $1.32 dividend. We divided by K minus G to get the present value, or excuse me, it's really the time 1 value of dividends D2, 3, 4, 5 on out forever. So taking the present value of those two pieces and adding them together, we get a value of $20.86. Now look if we did it the other way. Say we went one period too long. Well, conceptually, that's no different. What we're going to end up with is the present value of all these dividends in the future, or all our future expected dividends. So in this case, if we assume we held the stock for 2 periods, and then right after that second dividend has been paid, we grow that dividend at 5%, plug D3 here into the constant growth model over K minus G, that gives us a time 2 value. So we take the present value of the first dividend, present value of the second dividend, and then take that terminal value, and that's a time 2 value, so we discount that for 2 periods as well. So be careful about that. One thing that confuses candidates a lot when they first try to do these calculations is they see that D3 is in that calculation. They want to discount by 3 periods. But the fact is we plug D3 into the model to get a time 2 value. So that's why we're discounting that 23.17 for 2 periods. Same as we did that dividend of $1.32 that comes at the end of the second period. Let's look at a problem on valuation. We've got a stock not expected to pay dividends until 3 years from now. The dividend's expected to be $2 a share. The dividend payout ratio is expected to be 40%, and the return on equity is expected to be 15%. So we've got our pieces to calculate G. That should become second nature to you. Our required rate of return is 12%. So we need to value that stock today. Well, let's go through the steps here and see if we can get to that right answer of 53. So first we calculate G, right? We've got the ROE times 1 minus the payout ratio, so we've got a 9% growth rate. Our dividends is not expected to pay dividends until 3 years from now. So our first dividend is D3, coming 3 years from now. If that dividend is expected to grow at this 9% forever after that, our K minus G is 12% minus 9%. Our initial dividend is expected to be $2, and we get a value of 66.67. But remember, using that formula gives us the value 1 period before that dividend is paid. So our 66.67 is actually a time 2 value at the end of the second year. So we need to discount that value back 2 more periods at 12%, our required rate of return, and get a time zero value of those expected future dividends of 53.15. Now, when should we use this model? Well, clearly the Gordon growth model is most appropriate for firms that pay a dividend that will grow at a constant rate. I mean, that's what fits the model. But what types of firms are these? Well, stable and mature firms, non-cyclical firms, might be reasonably approximated by a constantly growing dividend over time. The two-stage dividend discount model, well, if we have a firm with a high current growth rate and we think it'll fall to a stable rate in the future, which it must. I mean, no firm can grow faster than its required rate of return forever. The reason the model doesn't work is that the value would be infinite in that case. Pretty soon the value of that firm would be greater than the whole rest of the value of the stock market. And if we could have had an older firm that was in the constant growth phase, but now went into a high growth phase or a low growth phase, declining market share, we can estimate for that period and then assume it goes back to some constant growth rate some periods out. We could use a three-stage dividend discount model. Might be appropriate for a young firm still in the high growth phase. So we may project, 20% growth for 3 years and then 15% growth for 2 years and then settling down. So that's where this idea of three-stage comes from. But in any case, the methodology of solving for the present value of those dividends is the same. Project out every expected dividend or forecast every expected dividend until you get to one that you expect will grow at a constant rate forever. That's when you can apply the constant growth model and get a future value, take the present value of all the dividends prior to that, add it all up, and that'll be your present value of the firm's future dividends or your estimate of the firm's intrinsic value. Now we can take this formula that we have and from that get a price-earnings ratio, which we call the price-earnings ratio based on fundamentals. The underlying assumption here is that the firm will be priced according to this constant growth model. So if it's priced according to P0 equals D1 over K minus G, then we can divide both sides by E1. So we've got a price-earnings ratio. We call that a leading price-earnings ratio because it's the current price divided by earnings expected over the next period, the next year. Now notice that when we do that, divide both sides by E1, so we get the leading price-earnings ratio over here. What we have in the denominator there is our payout ratio. So the payout ratio over K minus G gives you our estimate of what the price-earnings ratio would be if this valuation held. So what are the primary determinants of a PE ratio? Well, as we look at it here, with other things constant, a higher payout ratio leads to a higher PE and presumably a higher stock price. A higher required rate of return on capital, a higher K, is going to decrease this. So a riskier firm will have a higher required rate of return, other things equal, and a lower price and a lower price-earnings ratio. G, on the other hand, has the opposite effect. If the growth rate goes up, the PE ratio goes up because the denominator gets smaller. But one thing you should understand, it's one thing to understand this formula and say, well, if I change this, it would get bigger. If I change this, it would get smaller. So if you're asked a question, what's the effect of this, other things equal, then that's the right way to approach it. But in another sense, we can't just tell a company, well, if you want to raise your stock price and your PE ratio, just increase your payout ratio, just increase that numerator. Because what happens if we increase the payout ratio, the retention ratio is less and our growth rate is less. So unless we say other things equal, if we say, well, for a given firm, if they increase their payout ratio, what will that do to their PE? Well, we don't really know because we've got two opposite effects going on here. The PE would be higher because of the higher payout ratio, but it would be lower because of the lower growth. So, other things equal, higher the dividend payout ratio, higher the growth rate, and the lower the required return, the higher the PE. Let's take a look at another example here. You expect a firm to pay out 30% of its earnings as dividends. Earnings and dividends are expected to grow at a constant rate of 6%, and you require a 13% return on the stock. What's the stock's expected PE ratio? Well, we can calculate that. We know we need the dividend payout ratio in the numerator, and that dividend payout ratio is 30%. Here's our required rate of return. Here's our expected constant growth rate of dividends, and that calculation results in our PE ratio of 4.3. Let's look at some other price multiples besides price earnings. We can also have price to sales ratios, price to book value per share, or price to cash flow. And remember, we're talking about free cash flow that could be distributed, not required just to maintain the business. So when we use these price multiples, it's kind of like the law of one price. And we say, well, gee, these two firms are similar, they're comparable. So $1 of sales for this firm should be worth the same as $1 of sales for this firm. Or at least that's the assumptions underlying this type of relative pricing analysis. When we did that present value, the expected future cash flows, whether that was dividends or free cash flow to equity, that was an absolute valuation formula. We were using current interest rates, discount rates, risk, expected future dividends to calculate a value for the stock. Here, we're going to look at the price sales or price to cash flow ratio of a firm and say, well, given these comparable firms, this ratio should be this. Let's multiply that, say, price to cash flow ratio times the estimate of cash flow per share, and that should be the value of the firm. So that's a relative valuation because we're taking the price earnings or price sales or price book ratio of what we believe to be a comparable firm or the average for a number of firms in their industry. Now another multiple that we use is this enterprise value to EBITDA. Now enterprise value, you need to know the definition of this. It's market value of common stock plus the market value of the debt minus any liquid cash and short-term investments. So enterprise value, the value of the whole enterprise, equity and debt, but we're going to back out any cash and cash equivalents, short-term, low-risk investments. So EV represents the total market value of the firm, and this EBITDA represents the total earnings. Now, since it's before interest, taxes, depreciation, and amortization, it's a cash flow measure, but it's a cash flow measure before any costs of financing. So this EBITDA is what's going to go to pay the interest and also generate net income for the common shareholders. So that's why we say it represents the total earnings to both debt and equity investors. And when do we want to use these EV-EBITDA ratios, enterprise value multiples? Well, when firms have different capital structure, right, they have different amounts of debt and equity, and we're looking at a measure that's kind of above those financing costs, so it's the return to all holders, both debt and equity holders. Well, then the capital structure doesn't matter that much for this type of multiple. This can also be used when earnings are negative. Well, we can't get any sensible answers out of PE ratios when earnings are negative. So when earnings are negative, you might want to use an enterprise value multiple. Let's take a look at an example of a calculation. We've got a stock price of 40, 200,000 shares outstanding. We've got long-term debt outstanding with a market value of 600,000 and book value of 900,000. The book value of total debt and liabilities is 2,100,000. That's our total debt and our liabilities. Out of that, we're going to take the cash and marketable securities. And our EBITDA is $1 million. So once we have those numbers, it's a fairly straightforward calculation. We're going to determine the market value of the short-term debt and liabilities. Assume the book value equals the market value for short-term items. Changes in interest rates don't change the values of 90-day debt very much at all. Book value of the total debt minus the book value of long-term debt gives us that book value of short-term debt of $1,200,000. Our second step here is to get the market value of total debt. So we want the market value of the long-term debt and then add in what we just calculated as the approximate market value equal to the book value for short-term debt and come up with total debt market value of $1,800,000. Step 3, we need the market value of equity. That's simply the stock price times the number of shares. So that's $8 million. So step 4, what is the enterprise value? Well, it's the market value of the debt plus market value of the equity minus our cash and short-term cash equivalents. $1.8 million plus $8 million minus our $250,000 in cash gives us an enterprise value of $9,550,000. And then we divide that by our EBITDA of $1 million and get a ratio of 9.6. So what we would do, as I said, it's a relative valuation. So we'd compare this 9.6 to an individual competitor that we think is very similar, a comparable company, or to some sort of industry or peer group average. And low values would indicate it's underpriced. So if we see two similar firms, one has a lower EV to EBITDA ratio, our enterprise value multiplier, then we suspect that was undervalued and that its EV to EBITDA multiple will increase over time. Now we get to our third valuation models, or our third type of valuation models, asset-based models. Well, there's not much to do in terms of calculation for you for asset-based models. It's really an understanding of when that might be appropriate and what the limitations of these are. So equity equals the market or fair value of assets minus liabilities. And analysts usually adjust asset book values to market values because we're really looking at a market value here is what we want. And an asset-based valuation model really provides a floor value. Because if this company is an ongoing enterprise that's growing and we expect creating value in excess of what it costs to buy its assets. So that's why we say this is a floor value. It's kind of a minimum value that the firm would have, but the value could be much higher if the firm's employing the assets of the firm to generate earnings that have an even greater value than the assets. So let's compare and contrast these now. When do you want to use which? What are the pluses and minuses? The advantages of the present value models is they're theoretically sound. If we knew the future cash flows and at what rate to discount them, we'd be good. We would have the value of the firm. And these are very widely accepted models for that reason. But the inputs must be estimated, and valuation can be very sensitive to input values. If we're talking about a required rate of return of 9% for our K, and we say, well, G is 6%, that's our denominator. So we're really multiplying that D1 by 1 over 3%, by 33. But what if this goes up to 7? Then 9 minus 7%, we're dividing by 0.02. That's like multiplying by 50. So that's just one example of how sensitive these values are to our estimates of the growth rate, the required rate of return. Now, the multiplier models are also widely used and associated in some studies anyway with stock returns. That is, stocks with lower PEs, lower price to sales, lower price to book, or lower price to cash flow have been shown in some studies to have higher returns over time than firms with higher values for those ratios. These multipliers are easily calculated, and the data is readily available to calculate them. And they can be good for identifying attractive companies within an industry. Comparing the price to sales ratios for firms in an industry might lead us toward the one that is undervalued. And these are useful in time series or cross-sectional analysis. That is, you can look at historically what's been a firm's price-earnings ratio over the years, or you can compare the current price-earnings ratio to other firms or peer groups of firms. That would be your cross-sectional analysis. Now, some of the disadvantages of these multiplier models are that differences in accounting methods reduce comparability. So if you've got two firms using different accounting methods, then a comparison of their price to book values has less meaning. They're just not comparable. And multiples for cyclical companies are highly variable. When you look at the price to earnings for a cyclical firm, it can move all over. At the peak, that price-earnings ratio may be very low because those earnings aren't expected to persist or grow. However, at the bottom of the economic cycle, when earnings are very, very low, that price-earnings ratio can be very, very high. So that's a disadvantage, is that applying these price-based ratios to cyclical firms will get very cyclical ratios. Now, the asset-based models, we said they can provide a floor value, but they're most useful when the firm has mostly tangible short-term assets or if the firm is going to be liquidated. As I said, if the expected earnings on an ongoing basis give a value much higher than that, well, there's a reason for that. So the asset values really aren't the relevant values in the case of an ongoing firm that's productively using its assets to generate a growing stream of earnings. Ongoing firm value may be greater than asset value. That's the point. Fair values of assets can be difficult to estimate. We've got the accounting values, we've got the book values, but what's the really market value of the firm's assets? That can be difficult to estimate, especially if we have intangible assets, patents and trademarks and things like this, or in a high inflation environment. Those fair values are hard to get at as well. So let's conclude with this slide on choosing a valuation model. How are we going to choose amongst the three types of models that we talked about? The dividend discount models or cash flow discount models. And then we had our multiplier models, including our price-based ones and our economic value to EBITDA, or enterprise value to EBITDA. Well, the model should be chosen based on its intended use and also the inputs that are available. Clearly, if you don't have dividends, you can't do a dividend discount model very accurately. Remember that more complexity is not necessarily better. Sometimes the simple models give you less chance to do something foolish in your valuation or your estimates. But this doesn't mean you have to choose one. You can consider values using more than one method. If you use a dividend discount model, why not also look at price to sales, price to cash flow, enterprise value to EBITDA and see, are more than one model telling you this is undervalued, or is it only a particular measure that's telling you it's undervalued? Consider the uncertainty about your input values. That's another good reason to use more than one method. And consider uncertainty about the appropriateness of the model. If we've got a single stage model, dividend discount model, where we're assuming a constant growth rate, you've got to wonder, how appropriate is that, and how well is that going to fit reality?